Let's be real, folks. Financial literacy isn't exactly a hot topic at most backyard barbecues. It's not glamorous, but it is crucial. The sad truth is, many young people are thrown into the real world without a clue about managing their money. And investing? Forget about it. It can seem like a foreign language. But here's the deal. You work hard for your money. Don't you want your money to work hard for you? That's where investing comes in. Investing in the stock market can seem intimidating, but it's like anything else worth doing. You learn the basics, you make a plan, and you get started. Ignoring investing is like ignoring a flat tire on your car. Sure, you can keep driving for a little while, but eventually, it's going to catch up with you. The sooner you get a handle on your finances, the sooner you can start building a secure future. This isn't about getting rich quick. It's about taking control and making your money work for you instead of the other way around. This is about building wealth over time. It's about taking control of your future and securing your financial freedom. Are you ready to take charge? Let's dive in. Imagine sitting with your friends, casually discussing your financial goals and sharing investment tips. It might sound far-fetched now, but it's entirely possible. The first step is education. Start by reading books, watching videos, or even taking online courses about investing. Knowledge is power, and the more you know, the more confident you'll feel. Next, get your financial house in order. This means setting up a budget, paying off high-interest debt, and building an emergency fund. These steps are crucial before you even think about investing. Once you have a solid financial foundation, start exploring different investment options: stocks, bonds, mutual funds, real estate. There are many avenues to consider. Each has its own risks and rewards, so take the time to understand them. Don't hesitate to seek professional advice. A financial advisor can help you create a personalized investment strategy that aligns with your goals and risk tolerance. Remember, investing is a long-term game. It's about setting goals and being patient. The market will have its ups and downs, but staying the course is key to building wealth over time. Celebrate your milestones along the way. Whether it's your first investment, reaching a savings goal, or seeing your portfolio grow, these achievements are worth acknowledging. And who knows, maybe one day financial literacy will be a hot topic at your backyard barbecue. Because when you and your friends are financially savvy, you're not just securing your own futures, you're building a community of informed, empowered individuals. So are you ready to take the plunge? Investing might seem daunting at first, but with the right knowledge and a solid plan, you can make your money work for you and secure a brighter future. Let's dive in and start this journey together. Your future self will thank you. Remember, the best time to start investing was yesterday. The next best time is now. Let's get started. Are you ready to take charge? Let's dive in. Let's break down this whole stock market thing. It's not as complicated as some folks make it seem. Imagine your favorite company. You know, the one that makes those awesome shoes or that killer video game you can't put down. When you buy stock in that company, you're essentially buying a tiny piece of ownership. You become a shareholder, part owner of that business. Pretty cool, right? Now, as a shareholder, you're entitled to a portion of the company's profits. Companies distribute these profits to shareholders as dividends. It's like getting a bonus just for being a part owner. The value of your stock can also go up or down depending on how well the company is doing. Think of it like this. If the company is killing it, your piece of the pie becomes more valuable. If they're struggling, well, your piece might be worth a little less. But remember, we're in it for the long haul. The stock market is basically a giant auction. It's a place where people buy and sell stocks every day, creating a dynamic and ever-changing environment. Imagine it like eBay, but instead of vintage records and used furniture, you're trading pieces of companies. These pieces, or shares, represent ownership in a company. The price of a stock goes up when more people want to buy it than sell it. This is driven by demand, and when demand is high, prices rise. Think about it like a popular toy during the holidays. If everyone wants it, the price is going to skyrocket. The same principle applies to stocks. High demand leads to higher prices. Conversely, if fewer people are interested in a stock, the price will likely go down. This happens when supply exceeds demand. Simple supply and demand, folks. It's the fundamental principle that drives the market. Now you might be wondering, where does all this buying and selling actually happen? That's where stock exchanges come in. These are the platforms where stocks are bought and sold. These exchanges are like the bustling marketplaces of the stock world. They facilitate the trading of stocks and ensure that transactions are carried out smoothly. The New York Stock Exchange, NYSE, and the Nasdaq are two of the biggest and most well-known exchanges in the world. They play a crucial role in the global financial system. They're where all the action happens. Traders and investors from around the world participate in these exchanges. It's important to remember that the stock market is driven by a multitude of factors: news, economic data, company performance, and even geopolitical events can influence stock prices. Even plain old investor sentiment plays a significant role. How investors feel about the market can drive prices up or down. It can be a wild ride, with prices fluctuating up and down. Volatility is a natural part of the market, but don't let that scare you. Volatility also presents opportunities for savvy investors. Remember, we're not playing a short-term guessing game. Successful investing is about long-term planning and strategy. We're in this for the long haul. By focusing on long-term growth, you can ride out the ups and downs of the market. Diversification is key. By spreading your investments across different sectors and asset classes, you can reduce risk. Historically, the stock market has shown a tendency to grow over the long term, despite short-term fluctuations. Doing your homework and staying informed can help you make better investment decisions. There are plenty of resources available to help you learn about investing. Take advantage of them to build your knowledge. With patience and a well-thought-out strategy, you can achieve your financial goals. The stock market can be a powerful tool for building wealth. So, whether you're a seasoned investor or just starting out, remember that the key to success is staying informed, being patient, and thinking long-term. The stock market is a fascinating and complex world, but with the right approach, you can navigate it successfully. Keep learning, stay focused, and remember that every investment is a step towards your financial future. And as the market closes for the day, remember that tomorrow brings new opportunities. Happy investing. Section 4. Indices. Tracking the pulse of the market. Keeping track of every single stock in the market would be like trying to drink from a fire hose. Impossible. Imagine trying to monitor thousands of stocks, each with its own set of data, trends, and fluctuations. It would be an overwhelming task for even the most seasoned investor. That's where stock market indices come in handy. These indices simplify the process by aggregating data from a select group of stocks, providing a more manageable way to gauge market performance. These indices are like scoreboards that give us a snapshot of how the overall market is doing. Just as a scoreboard in a sports game tells you the score without needing to know every play, stock market indices offer a quick overview of market health. Think of them like the best of playlists for the stock market. Just as a music playlist curates top songs, indices curate top-performing stocks, making it easier to follow market trends. They group together a selection of stocks that represent a particular sector or the broader market. This grouping helps investors understand how specific areas of the market are performing, whether it's technology, healthcare, or consumer goods. One of the most famous indices is the S&P 500. This index is widely regarded as a benchmark for the overall U.S. stock market. It tracks the performance of 500 of the largest publicly traded U.S. companies. These companies span various industries, providing a comprehensive view of the market. Another big one is the Dow Jones Industrial Average, often referred to simply as the Dow, which follows 30 major U.S. companies. These companies are leaders in their respective industries and are considered blue-chip stocks. These indices give you a good feel for the overall health of the market without getting bogged down in the performance of every single stock. They act as a barometer, indicating whether the market is trending upwards or downwards. It's like taking the temperature of the market. Just as a thermometer gives you a quick read on your health, indices provide a quick read on market conditions. Is it running hot, or is it cooling down? By looking at indices, investors can gauge whether the market is experiencing a bull run or a bear market. Indices help us understand the bigger picture of the stock market. They offer insights into market trends, investor sentiment, and economic conditions. They're a valuable tool for investors of all levels, providing a foundation for making informed investment decisions, especially those just starting out. For new investors, indices offer a simplified way to enter the market, reducing the complexity and making it easier to learn the ropes. Over time, indices also help track long-term trends. By studying historical data, investors can identify patterns and make predictions about future market movements. And it's not just about the U.S. market. There are indices for markets around the world, allowing investors to track global economic health and diversify their portfolios. Comparing different indices can provide deeper insights. For example, comparing the S&P 500 with the Nasdaq can highlight differences in performance between large-cap stocks and tech-heavy stocks. Ultimately, indices are a powerful tool in an investor's toolkit. They simplify the complex world of stock markets, making it easier to make informed decisions and develop effective investment strategies. Section 5. The Wealthy Mindset. How the Rich Approach Investing. Ever wonder how the wealthy seem to make their money work for them? It's not about luck or magic, it's about mindset. You see, the wealthy understand that investing is a marathon, not a sprint. They're not looking for get-rich-quick schemes, they're playing the long game. They focus on building wealth slowly and steadily over time. They embrace the power of compound growth, which is basically earning interest on your interest. It's like a snowball effect for your money. The wealthy also understand the importance of patience and discipline. They don't panic and sell every time the market takes a dip. They know that fluctuations are a natural part of the game. They ride out the storms and stay focused on their long-term goals. Remember, building wealth takes time. It's not about timing the market perfectly, it's about time in the market. The sooner you start, the more time your money has to grow.